The more banks lend, the more money that gets created, the more money that's in the economy. I think appraisers got way more blame for the financial crisis than we're actually responsible for. You hear politicians say all the time, well, the government will pay for that. Well, where does the government get their money?
I think a lot of people just see it as a black box. The appraiser just does their black magic, and the number that comes out, is either what I want to hear and I'm happy. It's not what I want to hear. And
I think rates could stay at 7% if we just knew they were going to stay there. Yeah. People would start to transact again. I'm coming from a selfish perspective. I just want people to transact. Episode 80 of Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. Jeff, we spend a lot of time talking about the day-to-day economic picture, what interest rates are doing, what housing is doing, inventories and all that sort of stuff. But occasionally in this podcast has really led us to you and I getting a little more enamored with more macro pictures and even occasionally academic subject matter. And it is very rare that I watch an episode of a podcast 3 times. And here I find myself having done this with the economist Richard Werner and Tucker Carlson from months ago. We talked about this. We dedicated an entire episode to it. But you and I are the actual definition of armchair economist here. And we thought we would actually bring an economist on. Who do we have with us today?
You bet, Mark. Excited to welcome Kevin Hecht, who is actually an economist and somebody with credentials in this space and knowledge beyond just listening to random podcasts and then opining on them. So, Kevin, we're really excited to have you here today. In fact, you were setting up that you were going to be lecturing on economic topics coming up. Tell us a little bit about kind of what your experience is in the space and what you do with the economist title.
Sure. Well, first of all, thanks for having me. I love talking about the economy. I love talking about economics. From an academic perspective, I am an adjunct professor of economics at a couple of colleges, primarily St. Louis University, where I teach macro, micro principles. I'm also the principal economist at a firm called, we just changed the name, so Pillar Economic Research Group, sorry. And so we basically do a lot of work around what's going on in the housing market and how does the macro economy affect the housing market and what might happen in the future. And if I could just start off with one thing. So I'm also a certified residential appraiser. That's where I got my start. And I say this all the time. I think there's a lot of synergy between what economists do and what appraisers do. And sometimes I think as appraisers, we forget how important what we do is to the overall economy. It's more than just that specific appraisal that you're working on. Because when you look at GDP, which is how we measure the economy, real estate in its entirety makes up a huge percentage of our GDP. And as appraisers, we contribute to that. And I think sometimes we overlook that. We don't give ourselves enough credit for how important we are to the overall economy. So I just wanted to kind of throw that out and ask appraisers to think about that as you go through your daily routine and you do your market research and you do your market analysis. There's a lot of ties to economics in what we do.
Boy, I really appreciate that perspective, that you bring, Kevin. And it is, I hear you say it definitely makes sense. It's maybe not something that I initially would have, thought about or maybe connected dots with. But at the end of the day, we're trying to understand an appraiser on a single assignment, kind of at the micro level. How do the competing forces, converge to determine what the market will pay for a particular property? But you zoom out, and in economics, the analysis is trying to answer kind of similar questions. How do these converging forces, combine to affect markets as a whole, whether it's real estate or otherwise? I think we'll kind of get into some of how real estate is impacted by macroeconomics, by monetary policy. Obviously lending rates and, all of that sort of thing. Just rounding out the topic of introductions, I have enjoyed, associating with you. You are also a USPAP instructor and a member of the National Association of Appraisers, which is kind of near and dear to my heart as well. So Really, really excited to have you here, Kevin. I think it's going to be a fun conversation as Mark and I at least, aspire to learn from somebody who's smarter and more credentialed than the two of us put together, I think.
Well, as a reminder, I try to tell everybody this, economics is a lot about common sense. So we'll try to, get it to that level, because I think we try to make it more complicated than it needs to be. So that's my starting point.
No, that makes a ton of sense. And I'm going to see if I can connect a couple of dots here for us as we kind of kick this conversation off. My wife and I, with a couple of our daughters, were watching a TV show. It's kind of one of these investigative, TV shows where, they try to connect the dots to figure out who did something and when, and then how to get the evidence to prove it. And there was this one scenario where this investigator had found that, combing through all this information from the suspect, they had found that they'd had a home appraised a couple of times, and they had found a discrepancy in the size of the home. I think it was maybe an apartment actually, but between two different appraisals, which led her to conclude, man, there must be a hidden apartment or like space in this room, in this building that we don't know about. And so, they started investigating, they find it, and obviously solve the case, right? But as I'm sitting there looking at it, I'm saying, well, that's not how appraisers actually measure spaces. They're not cutting out the interior space. If they had added something on to the exterior footprint, that would have become pretty apparent. There's kind of the nerdy appraiser in me that can't turn off that part of my brain. But for the purpose of the story, it kind of drew a logical connection as to how they were cued into the fact that there was something going on, and to look deeper into this, this space. I wonder sometimes, like Mark and I had heard this podcast interview that Tucker did, with Richard Warner. Some interesting, concepts, and kind of makes us step back and say, well, I'd always thought about monetary policy, banking, economic theories in a certain way. Maybe there's more to it. But I find that it helps to dive into and get multiple perspectives from people to kind of uncover what, is actually correct, where is there room for professional differences of opinion, or just perceptions of what's going on. Kind of as you'd set up, it is common sense, but not everybody has the same perspective on, what common sense might be applied to a certain situation. So anyway, that's kind of a long setup, but I just wanted to set the stage of we're really excited to talk to you a little bit about this credit creation theory concept. How does banking actually work? And then obviously tie that back into what are the impacts with residential real estate. But you had a chance to listen to that podcast as well. I think to kick things off, Kevin, I just love any of your perspective on, or maybe even a summary from your perspective of what is credit creation and how does that apply to banking? And maybe we start from there.
Okay. Well, first of all, I think it's important to recognize that as appraisers, and frankly, as the consumer, as the public, we look a lot at interest rates as the thing that drives everything that goes on in real estate. And that's not, it's a big part, right? And we've experienced that over the last couple of years as we've come out of the pandemic and we've had rates increase. But the underlying factor that I think a lot of people don't think about, and I think what was kind of one of the focuses of the podcast, was that whole idea of money creation and how banks create money. And a lot of people don't really think about that. And so just from a basic perspective, if you deposit money into the bank, what does the bank do with that money? They don't just let it sit there, right? Ultimately, they lend that money out. That's how banks make money. But every time they make a loan, they're loaning out money that has been deposited to their institution and essentially creating new money. And that process will revolve around the number of times that loan gets, or a new loan gets created. We call it the money multiplier. And it's not that complex of a process, except that oftentimes we don't think about how that increases money supply. And as money supply increases, typically rates will go down. So the more banks lend, the more money that gets created, the more money that's in the economy. The flip side of that, or one of the cautions, is that also leads to higher inflation, which is kind of where we've been over the last couple of years as well. The big picture issue is that all of this works together to drive the economy. And when you think about it from a real estate perspective, especially as an appraiser, we're looking at what is the driving force behind people buying properties, right? There's different factors that we consider. First of all, shelter, obviously. Investment is another big picture, and that is even more directly impacted by interest rates. And when we look at it from an economic perspective, when interest rates are low, it increases investment across the economy, increases productivity, which increases GDP, which makes the economy grow at a hopefully at a steady pace, right? That's the goal of every economy. Every economy wants to grow, but they want to grow at a steady pace. Wild swings make it very difficult for people, for businesses to plan. So slow, steady growth is the key. And when you think about banks lending money, the more money they lend, the faster money gets created. So there has to be some balance in that process. And in the podcast with Richard Werner, he talked about the fact that economists don't think about that. And I would disagree with that just a little bit, because in the very basic economic classes, in the principles of economics classes, we talk about that. I mean, we have a lot of information about the money multiplier. And in one of the classes I teach, we go through step by step what happens when somebody makes a deposit in a bank. So we know that banks are subject to required reserve ratios. So if you deposit $1,000 into a bank, the bank is required to hold a certain percentage of that, but they can loan out the rest. So let's just say it's 10%. So I deposit $1,000 into Bank A. They make a $900 loan to another person who deposits it in Bank B. They make an $810 loan to somebody else, and that process continues. But we started with that first $1,000. Now, again, put a couple of zeros behind that, and you can see how much of a difference that actually makes. A couple of things that are important, and obviously I haven't checked this in the last couple of months, but the last time I looked, the required reserve ratio in the United States was 0. Banks don't have to hold back any money. Now, prudence says that, hey, I'm not going to lend out every dollar that comes into my bank. If you've ever seen It's a Wonderful Life, classic example of a run on a bank that didn't have enough money to meet, well, they ended up having enough money to meet the depositors' withdrawals. But every bank thinks about that from the perspective of, what do I expect in terms of withdrawals? I want to make sure I have enough money to cover that, because that's a big part of making sure you are solvent, that you're financially stable. So we see banks holding back money. We see banks being, for the most part, prudent about their lending rates. And the Federal Reserve is a big part of overseeing that process, making sure that we don't have enough, or we don't have too much money in the economy, which is why I disagree a little bit with what he said about not considering the money multiplier, because I do think that's included. Maybe we miscalculated. Not that just like appraisers, economists never make mistakes.
Yeah.
But occasionally the models may not bear out the actual reality. And so I can see it from that perspective. But to say we don't take that into account, I'm not sure I agree with that directly. Then if you
Kevin, I'm sorry. It seemed like during the great financial crisis, I remember folks talking about the reserve ratios, and maybe it was investment banks that didn't really have this scrutiny at all, or some entity maybe wasn't looked at in these sort of ways, but had dipped their toe into mortgage lending. Boy, it feels like even 10%. That isn't a rule, but a suggestion maybe, and a lot of people probably keep pretty close. That feels like a really light number in the grand scheme of things.
Yeah, and I think it depends on the bank. I mean, I'm just throwing that out because currently, like I said, there is no requirement, but every bank is a business, right? So they're going to look at, well, how do I mitigate my risk? Just like lenders look to mitigate their risk through the use of appraisals. But I will say, to your point about the financial crisis, there were a lot of people. I mean, one of the biggest issues from my perspective about the financial crisis was the number of people that were involved who didn't understand the process. You mentioned people dipping their toes in. There were a lot of investment banks. There were a lot of investment vehicles that were created that people didn't understand, but they all wanted to be part of the housing market because it was going gangbusters. And in my opinion, that's a big part of what led to the downfall. I say this, so I'm also an appraisal instructor with McKissick. That's pretty much my everyday job, if you will. And almost every class I teach, I talk about the fact that I think appraisers got way more blame for the financial crisis than we're actually responsible for. We were just an easy target because if you've ever watched The Big Short or Too Big to Fail, you see all of the things that went on behind the scenes with the financial instruments specifically that led to people getting in over their heads and people not having that nest egg or that safety net, if you will, so that when things started to go bad, they couldn't recover. And that's kind of what led us, in my opinion, to where we are now. But it really wasn't the appraiser's fault, if you will. And this is one of the challenges in the banking system that we face, is that there's a lot of vehicles that are created that the ordinary investor doesn't understand, but they want to be part of it because it sounds good. I mean, that goes for every kind of investment. Jeff was talking about watching that. I watch a lot of things about financial crimes, right? And it always comes down to, well, that was too good to be true. And if it sounds too good to be true, it is. And look, you can think about that in terms of how easy credit led to people getting loans that they never should have gotten in the first place. So that all kind of works together. And then you look at it from the financial system perspective. You look at banks, you look at mortgage companies, you look at Fannie and Freddie, you look at the investors behind the loans. All of these entities play a role in the direction of the economy. And just look at one of the more recent directives for Fannie and Freddie to buy more mortgage-backed securities to increase liquidity in the market. That's going to lead to, or should lead to, more loans. Now, the other thing we can't overlook is, I'm trying to think of the right way to put this, but those events that we can't anticipate, like the war in Iraq. So I don't know if you guys have had this experience, but in my area, gasoline prices have already gone up 40 cents. That's going to have a huge impact on the economy if they stay at that level or if they even go a little bit higher. So when you look at the macro picture, there are so many individual things that affect what happened, but ironically, they all end up impacting interest rates and ultimately impacting the housing market.
Well, that really seems to be one of the themes that we touch on the podcast. Is there are just so many converging, currents within the economy that, like you say, Kevin. I mean, some of these, maybe you call them black swan events, or at least unanticipated events that start us down a pathway that you just don't anticipate. And it seems like with the great financial crisis, it was the failure of some major investment banks that kind of precipitated what might was going to happen anyway, but there was some event that kind of caught people off guard and then led to that. One of the things that strikes me about this conversation, and I think is one of the points made in this podcast that I think is interesting, is he argues that there are productive uses for credit and credit for uses of money, and non-productive uses, at least from a GDP and an economic perspective. He argues that the productive uses are those that go to business, that employ people and that innovate and that actually bring goods and services into the economy, whereas credit for asset purchases and consumption, end up, from an economic perspective, ultimately not being productive. They drive bubbles in pricing, which I think is what we saw in housing. And as you talk about, a lot of these novel, and kind of derivative products in like mortgage-backed securities and interest-only loans, things that people didn't understand fully what they were getting into. It led to a lot of liquidity. It led to asset prices going up, but then the bubble ultimately burst, and we saw a major correction in real estate there. Does that resonate with you? Kind of what's your perspective on productive versus non-productive uses of credit in the economy?
Yeah, so I mean, I do totally agree with that. I think, again, what we want to see is we want to see businesses expand. We want to see production expand. We want to see capacity expand. When we think about how that impacts GDP, it also impacts essentially our quality of life. It improves the quality of life in countries that have expanding GDPs. And you can look at this when we talk about non-productive uses. Think about the financial crisis. Think about the bubble. And I remember this vividly. I would do the same house every 6-9 months because people were getting equity loans or refinancing, taking that money, buying for lack of a better term, stupid things, right? Non-productive things. And then they would just keep refinancing themselves, thinking they were refinancing themselves out of debt. What they were really doing, to your point, is refinancing themselves into an asset bubble. And once that bubble collapsed, that was the start of the financial crisis. So I think when we think about productive versus non-productive, we, especially as people in the real estate field, think about buying a house as a productive use, which most of the time it is. But we have to be careful that we don't start to essentially use our house as a bank. I mean, you probably heard that term a lot during the financial crisis. People were just refinancing and taking money out of their house just like you would take out money from a bank. That's not a productive use. I will say that one of the things we're dealing with today, in fact, right before this podcast, I was reading an article about AI, right? The effect of AI, and a company just laid off 40% of its workforce because they are claiming that their gains in AI. I think, just from my perspective, we're a little bit over enthusiastic about what AI is going to be able to do. And we are definitely seeing some productivity gains, but I think ultimately they're not going to be at the expense of employment overall. And one of the things we have to be careful about is to understand where employment is headed, because if people don't have jobs, then obviously that fundamentally shifts consumption. So we're in a market that is basically fairly strong on the employment side. And as long as that continues, then consumption will continue. As long as consumption continues, growth continues. And that is part of what incentivizes businesses to expand, to add more workers, to add more machinery, to build new plants. So those things work together, and we need to make sure that continues to move forward. So I 100% agree with his discussion about productive use of capital.
Kevin, one of the things that I guess caught my ear as I was listening to how Richard Warner kind of came in. I guess even the era with which he came in, and Jeff referenced this too, was that the Japanese real estate had just gone out of control, and economists at the time were having a hard time connecting real estate prices to why they were going up to the extreme degree that they were, I guess. And we've just gone through that ourselves here, in COVID, not to the same level of extremity, of course, but gone up a lot. And we are now left with this affordability issue. And I guess one of the things that on surface level resonated with me was just that was that we've, is somehow this, money lending factor that you spoke of, the exuberance that we had and the amount of printing and leading to inflation, leading all this, it just doesn't feel very healthy. And I don't know what the result of that is here. It doesn't feel to me, other than about the amount that housing has come down, I don't get a sense that we're going to see some additional deep crash. So I don't know, just some kind of internal monologue, making external. What do you think about those things?
Well, first of all, you remember the term irrational exuberance, right? We heard that during or as an explanation, if you will. I don't think we're at that point. I mean, I hear this a lot, and I talk to a lot of people who are saying, are we headed for a housing crash? Is the economy going to crash because of things like artificial intelligence? And I don't see that either. I just don't see that, especially at the level that we saw it leading up to the financial crisis, for a couple of reasons. I mean, first of all, we have better controls in place. And no matter how you feel about the Federal Reserve, because we have a whole school of thought that the Federal Reserve we shouldn't have a Federal Reserve. We have the opposite side that thinks the Federal Reserve should have full control of the economy. They are a controlling factor. And from my personal perspective, and that's all this is, I think they've done a pretty good job of getting us through the worst parts of the crisis. I mean, you can go back and look at the blogs. I write a monthly blog for McKissick about the economy. I think we all expected a recession and maybe a fairly deep recession, and that never happened. And a big part of that is because of the actions the Federal Reserve took, again, at least in my opinion, to smooth out the economy, to make sure that we were kind of staying on an even keel. Not everything that the Fed did was welcomed, but I think that is why the Federal Reserve needs to remain independent, because they can make those decisions that might not make politicians happy, but keep the economy going on an even keel. I don't see, so I just did a presentation for a group of realtors about 2 weeks ago, and we were talking about the state of the market. And I mentioned that, while I'm looking at MLS, I see a lot more price reductions than we saw before. But they were telling me a story about a house that had 30 offers on it, and two of the agents there had written contracts. So we're definitely in a market where pockets are different, right? We have these segments of the market. And your point, Mark, about affordability, I wish I had the answer to that. I mean, that's one of the biggest issues that we're dealing with in the real estate market, is the idea of affordability. And all of the things that have been suggested, some of them have, kind of started to be tried. I don't think those are the things that necessarily are going to have a direct impact on housing affordability. Until we can get that segment of the market built up through additional units, I just don't see this problem resolving itself in a quick fashion. And you think about that segment of the market, if you will, the fact that we need entry-level housing. Nobody can afford to build that right now, what we would typically consider entry-level housing. You think about lumber prices, you think about labor prices, land prices. All of that has increased so dramatically since the pandemic that it's going to be really hard for builders to be able to fill that segment. So there's no easy answer, in my opinion, to the affordability problem, not without some external adjustment, maybe some buy downs or something like that might promote that. But even that, I think people are thinking, I don't know, do I really want to make that investment? Because I don't know what's going to happen.
It's hard to know. It seems to me that some of the rise, the significant rise in the real estate market generally has been the result of the policies that we're fighting COVID, ultra low interest rates, drove up asset prices. Now interest rates have come back up to fight inflation. And I mean, like you said, Kevin, I mean, I remember going through that era where it was like, yeah, the recession is right around the corner. This thing's going to come. It's going to come. And, nobody really thought that the Fed could pull off a soft landing. And it probably has done a pretty good job of that. I mean, in turbulent times, to be sure. But it does feel like we're left sitting here with asset prices in terms of residential real estate higher than they would have been if we didn't have the ultra low interest rates that facilitated that run up. And I don't know if that's necessarily credit creation, like driving asset, prices. It was certainly cost of money that was a factor there, it seems to me.
Yeah, so you bring up a really good point. And if your listeners ever go to the St. Louis Federal Reserve and go to their they call it the FRED database, and just put in money supply. And if you look at especially M1, that's how one of the classifications of money supply, you'll see that over the last 50 years, the increase in money supply has been fairly steady. Then we got to the pandemic and we saw this huge spike in money supply. And, one of the basic explanations for inflation is too much money chasing too few goods. And when we put that money into the economy, people felt wealthier. People, despite all the issues that were going on, people had this money. They were looking to use it, essentially. And a lot of them looked at the real estate market as a way to use that money. I will say your point, Jeff, about ultra low interest rates. Rates stayed low for too long. It's easy in hindsight to go back and say that. But you're absolutely right. The low interest rates led to a lot of activity that we wouldn't have seen had we probably been a little more prudent in interest rates. But I will say that one of the things people commonly have a misconception about is that when the Federal Reserve changes interest rates, or they alter the Fed funds rate, that's not a change in interest rates. It might lead to a change in interest rates, but the Fed doesn't directly control interest rates, whether that's savings rates or mortgage rates. And so we're still looking at how is the market interpreting what the economy is doing and what the economy needs. And that was a big part of why rates stayed low for so long. Now, again, I think the Fed probably, and I think they would admit this, they reacted a little bit too slowly in raising rates. And that's another reason I think inflation took the huge jump that it took. And they had to come back then and make some tough choices to get inflation back under control. And even though we're still not at their target, we're much closer, and we're seeing less volatility in inflation now than we saw 2 years ago. So that's a positive sign for the overall economy. Again, when you look at the macro picture, if as a consumer, I believe that prices aren't going to jump dramatically, then I can make better decisions. And that's really, what economics comes down to is how do I make the best decision given the resources that I have? And that's where information becomes important. That's where understanding just some of the basic fundamentals. I mean, we talk a lot in economics about supply and demand. And if people truly understand that, they're in a better position to make decisions about what they do with their own resources, with their own money. Because another one of the common misconceptions, and it's the thing I talk about in the very first class I teach when I teach principles, and you get a lot of 18, 19-year-old students in there who are all thinking they're going to learn the secret to getting rich. Economics isn't about that, right? It's about how we use our resources. And when you think about individually the resources that you have, they go beyond, just your paycheck. And if you think about the big picture there and the things that you make decisions about, and we call it opportunity cost, right? If I do this, then I can't do that. What's more important? If you start to think about your decision process in that method, I think it helps you make better decisions. And that applies to everything. That applies individually, to businesses, to any decision that you make. So that's always been one of my kind of soapbox issues, if you will. Think about things in terms of opportunity cost, not just in terms of how much they cost.
Yeah, I think a really good point, Kevin. That definitely makes sense. And I can only imagine talking to, 18, 19, 20-year-olds, trying to help them, kind of conceptualize how the economic world actually works. I mean, some real wisdom in that. I just have to make this comment before I think we make a pivot here. But I have this vision in my mind of like Jerome Powell waking up in the middle of the night with cold sweats, hearing this phrase transitory inflation, that because I think you're right. I think, had they pivoted faster to bringing up interest rates earlier and probably slower, there would have been less, pain and suffering in especially the parts of the economy that are very interest rate sensitive and driven. Real estate is certainly one of those. I know a lot of agents, brokers, appraisers, et cetera, who would have loved to have not seen rates move as quickly as they have. And certainly your point about, it's not Jerome Powell deciding what the mortgage rate is going to be. Their policies have certainly, impacted, I think, the rate at which they ultimately ended up adjusting. And, that part of the landing could have been, I think, softer and better. But like you say, it's always easy, after the game's played to sit back and say, man, the quarterback should have done this, that, and the other.
Well, if I could pat myself on the back a little bit, I said at a conference in 2020 that inflation was not transitory, that term was completely wrong. And I think, again, looking back, even the Fed, even Jerome Powell, and I would hope, honestly, that Jerome Powell did wake up in some sweat sometimes, thinking about the decisions that he needed to make and what needed to be done. Because look, it's not easy being the chairman of the Federal Reserve, no question about that. But at the same time, you think about all the information they have available to them, all the people that are involved in these processes, a lot of smart people. I think sometimes you just need to make a decision that is right, even though it's going to be unpopular. And that's where the independence of the Federal Reserve becomes so important. But I did say that transitory inflation was a term that was totally off base, because once people get that taste of money, right, it doesn't automatically stop at some point. They just human nature. And I think, one of the interesting things about economic models, and we talk about money creation from the standpoint that maybe we don't try to figure out human action or reaction and incorporate them in the models as much as we could or should. There's a whole field of economics called behavioral economics that is focused on trying to figure some of that out. But when people make decisions, when they take action, right? If we don't incorporate that in the model, and that could have been one of the things that he might have been thinking about when he was talking about money creation. People have this demand for money. Do we account for the actual demand? Because again, from a purely economic standpoint, the whole idea of banks creating money has been around for a long time. So that is something that, and it does have a big impact on the economy.
Well, Kevin, given your prediction accuracy record, and that Jeff and I are certain that both Jerome Powell and Kevin Warsh listen to this podcast, we would love to hear from you what you think will happen, but should happen in May and June here when we get a new and maybe less independent Fed.
So that's a great question. And I've been thinking about that a lot because, I mean, we all know or I think it's a pretty much foregone conclusion that Jerome Powell will not be reappointed as the chairman of the Fed. I mean, they've already started that process, although technically there's still a possibility that he could be reappointed. And when you think about the nomination process, and I don't want to get political here, but obviously there was a reason this person was selected. But I will say that, if you look historically at what Kevin's done, and he has a great name, by the way, just, throwing that out there. The name Kevin is synonymous with economic accuracy, I think. He has experience at the Fed. He is, at least on paper, someone who looks at the information, right? My personal guess is, educated guess, if you will, is that things are going to start to loosen up a little bit. The only caveat is we don't know where the military action is going to take us. How is that going to affect the rest of the economy? When this all started, that wasn't something we were even thinking about as far as I'm concerned. And now it's a big part of what's affecting the economy. And when we saw, again, oil prices go up, we've seen interest rates inch up a little bit. Will they continue? And I think until that's resolved, there's going to be a lot of uncertainty. And we all know the market hates uncertainty. If you've looked at your retirement accounts, you've probably seen some swings in what's happened because the market isn't exactly sure how to react to this, because I'm not sure we know the long-term goal here. What exactly are we trying to accomplish? What's going to happen when this is over? And that's going to have a big impact on what happens as we come out of this. Again, thinking about specifically oil prices. Will they come back down? Because even though I think we're less dependent on oil now than we were 20 years ago, maybe even 10 years ago, it still has a big impact on our economy overall. And whenever oil rates increase, it slows down a lot of the sectors in the economy as people try to adjust. So is this temporary? And I will say, I do think it's temporary. I think that once we get through this, things will come back to a more normal progression, a more normal trend, and then we'll get back into the business of growth, into the business of kind of more stable outcomes. But that could pivot depending on what happens in the Middle East. So that's a way for an economist to say, here's what I think, but if I'm wrong, it's not my fault. Something else happened to change my prediction.
Well played, sir. You spoke about kind of maybe a more modern field of study being behavioral economics, and you used the buzzword that's heavy on my mind and has been for the last 2 years, which is uncertainty. And it seems that this is right or wrong. The Federal Reserve actions to kind of keep us out of recession have created a psychological profile of a housing market participant in a way we've not really ever seen before. I mean, we've just seen a whole lot. And it seems to me, and I'm curious as to your reaction to this, it seems to me that I guess I'm hopeful for it, that getting a Federal Reserve chairman in to do something and then say this is kind of where we hope it's going to be for a long time. And obviously not those words. That's not an easy thing to say, but we've been living in this world where, hey, it might be better in 3 months. And we've been here for 24 months of people saying that. And right now we're waiting for June for the new Fed chairman maybe to be brought in. The market just sits still. Like, I'm not doing anything. So I'm just curious as to your thoughts on all of that.
Well, you make a really good point in the sense that I think the Federal Reserve has a much bigger influence on everything that happens in our economy than they did 15, 20 years ago, right? I think one of the positive things that's changed is there's more transparency. But to your point, what are they actually saying? Are they just hedging their bets, or are they giving us clear direction? And I think, frankly, there's been a mix. I mean, when we think about inflation, so one of my big issues with when we talk about what the Fed talks about in their focus on inflation is, we look at the difference between core inflation and overall inflation. And when you take out energy prices, inflation always goes down. But at the same time, you and I, we still have to make our mortgage payments. We still have to pay for electricity and natural gas. So I'm always a little leery when we take those out, because they still have a big impact on our spending. And if you look at the GDP calculation, right, it's consumption, which is what you and I buy, investment, which is what businesses do, government spending, and then net exports. And we haven't actually talked much about government spending, but you think about how much money the government spends. And let me just also give you another pearl of wisdom that I always start classes with. There is no such thing as government funded. You hear politicians say all the time, well, the government will pay for that. Well, where does the government get their money? Right. And I think too often we think, oh, well, the government's paying for that, so that's great. We don't have to worry about that. And yet, look at where we are in terms of our debt level. That's a concern that we keep pushing off. So how is that going to affect us? And, I'm kind of circular logic here, but you think about where interest rates are, and you think about another reason that we would want interest rates to go down is because every time that the government refinances its debt, it has to do it at current rates. And so for a long time, our debt payment was very low because interest rates were at ridiculously low levels. They're not there anymore. So our debt payments have increased. If rates start to go back down, then that takes some of the pressure off of those debt repayments. So it's again something to think about. But in terms of the Federal Reserve, I think it would be helpful to understand what their long-term, we know their long-term goal is full employment and low inflation, right? They want companies to be able to create jobs so that people can be employed, and they want to keep prices increasing at a steady pace. One of the things we also talk about is, should we have zero inflation? Well, the truth of the matter is we don't want zero inflation. We just want low inflation that is predictable, that keeps things rising at a slow pace, because that keeps everything moving forward. You think about, how wages grow. If inflation increases too fast and wages don't keep up, then we all end up behind. If inflation goes really low and wages increase faster, then people start spending money, which leads to an increase in inflation. So it's kind of this never-ending cycle. How can we get to that point where things are working like we want them to? And the Federal Reserve, whether it's by action or by word, has a big impact on what the markets do. And probably, at least from my perspective, maybe a little bit too much influence over the markets just by what they talk about, right? People, for a long time, you had a whole group of people that would read between the lines, if you will, of what the Fed is. And you watch CNBC after the Fed has a meeting, everybody's trying to interpret what the Fed said and what it really means. I think that to some extent, they've done a better job of being forthcoming and being, more direct in their speeches or their information. But it does have a dramatic impact or can have a dramatic impact on the market, which then affects everything else. So I think the Fed has probably a little bit too much influence on the markets right now and has, for the last couple decades, if you will.
Do you anticipate that changing with, assuming that Kevin Warsh is actually nominated and not nominated, but confirmed and put into place? Do you anticipate there being any sort of a change with how prevalent they are, kind of like the Fed is kind of out there in messaging I've gotten the sense he'd be maybe more inclined to be a little bit more in the background than what the Fed has been. I'm curious about your perspective.
Yes, probably, because I think his is going to be more about action, right? So he's going to, I think this is just, again, my perception. They're going to start to try to figure out ways to ease. So bring the Fed funds rate down, to encourage more borrowing, hopefully for that productive reason, because that's what expands the economy. And yeah, probably to an extent less in terms of talking about what they're doing, more about the action. At least that's my perception from what I've read. I mean, obviously I don't know him personally and I haven't really followed him, but the things I read about him say he's a very practical person and he does look at the data. You know, that's the other thing when we think about the Fed, especially the current administration, they're very data focused. And you go back to when the government was shut down and we weren't getting data, those kind of things create gaps. And when those gaps occur, sometimes it's difficult to get back on track because something happened. And really in this case, there wasn't anything drastic that happened, but it's something to think about when we talk about what kind of data we use. I mean, even as appraisers, we know that data drives everything we do. And it's even more important when we think about the decisions that are made that direct our economy. What does the data tell us? What we look at the data, are we growing? Are we contracting? And then what are the actions that we can take to get us on the track that we want to be on, which again, slow, steady growth.
Kevin, at one point, Jeff and I were covering on the podcast that the next Fed Reserve nominee was the battle of the Kevins, actually, because I think it was like Kevin, I can't remember his name, Haskin or something like that, and Warsh. And at the time, I was drawn to the descriptions of Warsh's philosophy as this transparency thing has created everyone's hanging on every word of Powell whenever, or any of the Fed governors when they speak. And that's not really the intention here. And they want to get out of the way to the degree they can. And I'm encouraged by that thought. I don't even know if that's properly attributed to his philosophy, but I sure hope that's the case. You know, like I think rates could stay at 7% if we just knew they were going to stay there. Yeah. People would start to transact again. I'm coming from a selfish perspective. I just want people to transact. And we've been holding off on that for quite some time now.
Yeah, and I think that if you look at what the market is saying about Kevin, he's very rule based, if you will. He again wants that data. So his decisions, the expectation is, I guess, based on what I'm reading, that he's going to follow what the economic indicators are saying. He's going to look at the information, and to your point, if nothing needs to be done, we're not going to do something just because people think we need to do something. And I think ultimately, assuming that politics don't overlap, that's going to reduce the uncertainty. That's going to give us that consistency that to your point, I think we're all looking for that. I mean, and it's not just in the housing market. It's every market wants that consistency, wants to know that things aren't going to jump up and down. I think there are, and again, just to maybe get a little bit off topic here, but I think it impacts the economy. You think about the recent Supreme Court decision about tariffs, right? So now all of a sudden that's all going to change. That's the kind of uncertainty that kind of puts markets into spins until we can figure out. So the sooner we can resolve things like that, the more clarity we have on what's going to happen. And I had this argument with my sister-in-law recently. You know, when you think about tariffs, they've generated some government revenue, but they also cause a lot of businesses to take a step back and have to reevaluate. And, you know, I read a story not too long ago about a company that ended up having to go out of business. Even though the tariffs were supposed to protect domestic production, it ended up hurting them to the extent that they couldn't compete. That's not good for the economy either. So, you know, there are pros and cons to just about every policy decision. The thing is, we can't have these constantly changing. And you think about, you know, how often the tariffs change over a short period of time for a while. That's the kind of uncertainty that gets markets worked up.
Kevin, one more question. In given your opening remarks and your seat as an economist and an appraiser, I'm looking for, and maybe for our listeners too, a little bit of comfort food here as we see you off. What is the role of appraisers going forward? There is this kind of thought out there that our role is minimizing in the marketplace. A lot of innovation at the GSEs, and I'm just curious from your seat, what do you think? What do you think this world brings to us in the next however many years?
All right, so you've opened up one of my soapbox issues. So, look, I think, and I say this all the time, we're not going anywhere. And I believe that the role of the appraiser is going to become even more important. Now, let's be honest, there are some properties that frankly don't need an appraisal. Somebody's doing a rate term refi they just bought 6-8 months ago. Does it really require an appraisal? And I think we have to accept that. We have to recognize that. But at the same time, you think about, I mentioned this earlier, how much real estate affects our GDP, how important understanding the true value of the assets is and is going to be. I think the role of the appraiser becomes even more important over the next decade, especially as we transition into some of these new processes. And I believe that the new URAR is going to let the appraiser demonstrate their expertise in ways we couldn't do with the current 1004. It's going to provide the reader of the report a better understanding of the data that we use to come to our conclusions. Now, that doesn't mean that we still don't have to dot our I's and cross our T's, and we can't just rely on all the technology out there. The technology is changing at a ridiculously fast pace. But I think that ultimately appraisers are going to be more important. But I also temper that with the fact that we have to take some action. I think one of the challenges with the appraisal industry, especially after the financial crisis and the introduction of all the regulations and the AMCs, we have to make sure people understand what we do as appraisers and why it's important. And that's one of my big goals. Whenever I get the chance to talk to an audience, I'm constantly talking about why an appraiser is important. Because I don't think the public really understands what an appraisal is. And I think as an industry, we need to do a better job of explaining that. Because if I'm going to buy a house and I get to the mortgage company and they say, well, we put everything in, it came back, you don't need an appraisal. You can just get a waiver, you can move on. Am I really comfortable making a $500,000, $600,000, $700,000, $800,000 investment without really knowing what my property's worth? And I don't know that people understand that they don't have to accept the waiver if they don't want. They can ask for an appraisal. And we, as an industry, need to do a better job of promoting what we do. And I think we've gotten a little bit, and I hate to say this, and I hope I don't alienate anyone, but we've gotten a little too comfortable with people just giving us work, right? We go on the internet, we go to our client's website, here's an order for us. We're not out there like we used to be. I mean, I've been in the business long enough to remember the days of hand delivering our appraisals, of taking donuts to the mortgage company, to having happy hours. I think we need to do more of that. We need to be more invested in helping people understand what we do. And organizations like the NAA and even the Appraisal Institute and the ASA, they're doing some of that, but I think individually we need to do more. So one of the things I always tell appraisers, if you ever get a chance to stand before a group of realtors or a group of people from the public and explain what appraisers do and why it's important, please take advantage of that. And I'll offer that if you're not comfortable doing that, reach out to me and either I'll do it or I'll find somebody who will do it. Because that's the way we elevate the recognition and the image of this industry. Because, look, I think we have a lot of responsibility. And that's another reason I think the transition to the new URAR is going to be helpful. I think, and look, again, I know, and I'm guilty of this too. We get a little comfortable using our can statements and our drop-down lists and all that stuff in the 1004. Now we're going to be approaching it a little bit differently. And I know it's different. And I know appraisers hate change. I'm one of those appraisers that doesn't like change either. But this change is, I think, good and frankly overdue. And the other thing I'll say when I hear people say, well, the Fannie and Freddie are just trying to get rid of appraisers. They spend a heck of a lot of money making this transition. I don't think they would, and I've talked to Lyle and Scott both about this. They wouldn't have invested this much money in this change if they were trying to get rid of appraisers. Again, I think appraisers are going to be more important to the process as we move forward. So that's my soapbox issue. Get off my soapbox.
Well, I think it's a perspective that we certainly would not disagree with, Kevin. And at the end of the day, and I've made this case a number of times, appraisers, just like any other service provider, are in a market. Yeah, and you have to bring value to the market that you're trying to serve. And I think that appraisers do. Honestly, I think it's one of the easiest things in the world to have a conversation with a group of, real estate participants, whether it's agents or brokers or whatever. All you have to do is say, hey, have you ever had an appraisal go bad or had an appraisal problem? And, every hand in the room goes up and they start asking, well, man, this appraiser did this and why did they do this and why did they do that? And, as long as you can speak, credibly and comfortably to what the valuation process is, why you do it, how you go about it, and help address some of those issues. The other thing I always find is that people are very interested in what appraisal is, in part because those in the space, their transactions are contingent on it in many cases. But, they want to understand, better how to value and price properties, and especially the good agents and the high production agents. They really care, and the ones I know locally, have a good relationship with, and they reach out to us from time to time to get help, to get perspective. And it should go both ways, I think, is what you're saying, is that communication should go both ways. And as appraisers, we should be well versed and well communicative with the other market participants, out there in the space. And it just drives improved credibility, improved understanding of what the process is. And I think a lot of people just see it as a black box. The appraiser just does their black magic, and the number that comes out, is either what I want to hear and I'm happy. It's not what I want to hear, and then the appraiser, is an idiot or something. And there's just a lot more to it. And when you can explain what you've done and why, it goes a long way to kind of bridging that gap, even if it's not what somebody might want to hear in a particular situation.
Yeah, it's always the appraiser's fault. Which brings me to another thing, if I could. I always ask in classes that I teach, how many people have done a low appraisal? And hands go up. And my contention is you've never done a low appraisal. It's a market value appraisal. It's not low, it's not high. And one of the things that I would encourage appraisers to stop using is that term low appraisal. When you call an agent, which I think you should if you're coming in below contract, don't say I'm coming in low, because you're not coming in low. It is what it is. And to your point about, agents not being happy, it's not because the appraisal is low. It's because the market is telling us that this is the data, and we're just interpreting that data. Now, again, that doesn't mean we don't make mistakes sometimes, and we have to be accountable for that. We have to, be willing to look at that. But most of the time, and I say this too, we're the only people in this transaction that don't care whether it comes out at 50,000 or 500,000. It is what the market tells us it is. So I think if we look at it that way, we dot our I's and cross our T's. And to your point, Jeff, provide that value, then we're doing a service not just to the mortgage industry, but to the economy overall.
100% agree. And I think that's the challenge and also the opportunity going forward is, we really can provide value to the marketplace, in mortgage transactions and certainly well outside of that as well. But it's important that you provide something that the market cares about and is willing to pay for in the long run. And that's, I think the challenge that we all have. But boy, Kevin, it's been a lot of fun. You've been very generous with your time. We didn't even warn you how long we'd have you held hostage here, going through the conversation. So I know that you have lectures and other more important things to do today still, but we really appreciate you coming on and perspective generally. Mark and I really aspire to understand better the world and the markets in which we operate. And, experts like you really help, I think, deepen our understanding of how certain things work. Economics is a passion project for both of us, even if we aren't as respectable and credentialed as you are.
Well, I really appreciate it. And I love talking about economics. So always happy to do that, no matter how long. I mean, I could talk for another 6 hours if that is. But yeah, no, thanks very much for the invite, and hope that we covered everything. And if any of your listeners have questions, they're welcome to reach out to me. You can find me on LinkedIn. You can find me at mckissick.com. So always happy to talk about the economy.
Well, really appreciate it. Kevin is a heck of a nice guy. I can give him a personal endorsement as well. So yes, absolutely reach out, or happy to get anybody connected with him as well. But Kevin, a big thank you, and until next time.
Thank you, Kevin.
Thank you.